Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. One of the reasons I absolutely love dividends is the fact that you get dividend increases even though you haven't actually done anything. You buy a stock, you hold it, the company then increases 5%, 10%, 15%, just the dividends. And that as an investor is absolutely amazing to see. Not only are you going to get paid, you pay actually gets more and more. The more you hold that stock, the more money the company gives you, which is absolutely brilliant. And this is why I love dividend growth stocks. There are stocks out there that do not increase the dividends that much. And there are companies out there that really increase their dividends. And the reason they do that is because they want to give something back to the shareholders. And some of these companies will give you price appreciation as well as the dividend increases. And that's why I absolutely love when it comes to dividend growth is investing. And if you are in your, let's say, 20s, 30s, right, even 40s, you then have to obviously look at your portfolio, because you're not at your 40, unless you've already retired, whatever, you're not going to look at your portfolio. You're not going to need that income straight away. So what you should be buying is dividend growth companies that could potentially be increasing that dividend every year, year after year for the next 10 years, 15 years, right? But obviously, if you are after the income right now, then obviously that should be slightly different. You should be buying most stocks that have more, pay more dividends right now rather than growing that dividend. So what I have for you today is 7 different companies that have increased their dividends in basically in the month of December. So I'm going to share the details of each one of these companies. But before we do that, I need you to basically subscribe to this channel if you haven't already, because apparently quite a lot of you that actually watch the videos are not subscribers. So that's the first thing you're going to do, inshallah. And the second thing you're going to do is like the videos and share it with your family and friends. And honestly, it helps the channel to grow. And inshallah, I've got holiday coming up soon. I'll be putting a lot more videos out there and just do a little bit more research and look around again. Lately, I've been focusing more on basically just analyzing stocks. Now we're going to basically sit back and actually think about what other things that can we actually include in terms of going forward. And like, for example, we used to do videos on basically talking about general markets, the news, if you like, if you want to talk about in financial literacy side of things. So there are quite a few things that I've got planned, inshallah. I just need to sit down and execute them. So inshallah, if you like that kind of thing, as always, subscribe to the channel. Let me know if you have any questions. And now I've got a few people that have asked me questions the last few days. Inshallah, I will be able to answer it this week, inshallah, this weekend. Right, before we do that, a lot of things has happened. Markets are very much down today. And it's because so much has happened in the last 24 hours, starting with the Fed rate. Okay, so the interest rate is in the US has now gone up 0.5, right? And that was what was expected. So the Federal Reserve Committee came out and said, this is what we're going to do. We are going to increase the 0.5, which was what was expected. And they kind of hinted it will carry on this way for a while, maybe. Obviously, will have to bring it down to 0.25, which is normal, if you like. So they're going to continue doing this for the next at least 2-3 meetings. So we'll see what happens with that. For that reason, the US stocks were down. Also, Europeans central bank came out and obviously said the same thing. And what she said was very interesting. I watched her talk today. This lady called Christine, she basically said we're not pivoting. That means we're not stopping anytime soon to increase these rates, because inflation is still very high. So inflation being around 9-10%, they will need to carry on doing this. So we're not out of the woods yet. There's a long way to go. And UK as well came out, England, okay. The Bank of England came out and said, okay, we will increase it by 50 basis points, but also we will continue doing this until inflation comes back down to 2%, right? So from 10% to 2%, that's a long way to go. So we are definitely not out the woods. December is always a tricky month for the markets. So we will see what happens. There's a lot of options in the UK in the US expiring next couple of days. I think tomorrow, So the markets will be very much up and down in the next few weeks. So it might give us an opportunity to buy actually some quality companies. And when you look at the European companies, it's actually down quite a bit today, especially the German. The FTSE was down a little bit, not too much. The French was actually okay, and so on. And when you look at the US, for example, right now, you can see the Dow Jones is down 800 points. That's quite a lot. So that's almost 2.5%. The S&P 500 is down 2.5%, and the Nasdaq is down 3% right now as we speak. And this is what it looks like. It looks like the S&P 500. It just looks ugly right now. But you know what? Genuinely, I look at this, I'm like, this is a great opportunity for a long-term investor to actually add to some of the stocks they wouldn't wanted to buy. Unfortunately, I bought a couple of stocks the last few days. So I will be, after this video, I will be actually looking at my portfolio again, and then maybe just buy a couple of shares of some of the companies that I want to increase, inshallah, in the next few weeks. So it gives another opportunity. If you are a long-term investor and you're thinking about 5 to 10 years from now on, the fact the markets are down 2%, 3% today will not matter. Trust me. Okay, so you just have to basically nibble as much as you can here and there and carry on. So right, let's now go back and start looking at the 70 stocks that I've talked about. As usual, we're looking at the same sort of a criteria. And the first company we're looking at today is the Waste Management. Waste Management is one of those companies. It's basically a garbage collection company, and they recycle it. They do all the basically taking it from the garbage to actually recycling it on, so all of that. Market cap right now, we're looking at about $68 billion. It has a wide economic moat, $163 per share. Dividends of 1.56%. Latest increase was 7.7%, which is really good. And this company has been doing this for the last few weeks. I mean, the last couple of years. I used to own it. I sold it. That was a bad mistake. I should have held on to it. It's one of the companies I'm waiting for it to come back down, because as you can see, it's a little bit expensive right now. But I would love to own this company again, because they definitely have that increasing, boring, like revenue, if you like. They have a business that's boring. Not many people like it, but can you imagine getting 7% increase every single year? At the same time, they have excellent free cash flow, and then they are growing their business and so on. So that's probably why it's actually trading higher multiples. So when you look at the 5-year growth rate, 7%, payout ratio only 45%, which is really nice. Dividend growth streak for 18 years. Safety 74% according to Simply Save Dividend. Profit margin 11%, return on equity 31%. Almost $2 billion in the bank right now. And basically you would have made about 19% in the last 10 years if you had actually owned this company. And that is total return, which is obviously your dividends as well as the price appreciation. Next year they're expecting the earnings to grow 7%, so that's 2024 fiscal year. And then after that 12% every single year. Premium right now 29% premium right now, almost 30%, 129. I don't think I'm going to see this company around this price, I'll be honest with you. So sooner or later I might start nibbling, just adding here and there. If it comes back down at least maybe another, let's say 10%. If it comes down by 10%, I might start looking again and just add a little bit and just pay that extra premium for it, because I do believe this is a quality company. The next one is the one I own in my portfolio. That's Amgen. Okay, that's biotech company. It has wide economic moat, $145 billion market cap, $265 per share, dividend yield of 2.86, and latest increase was 9%, or almost 10% if you like. 5-year growth rate of 12%, payout ratio of 42%, and then dividend increase basically is dividend streak is 10 years in a row. Safety 74%, profit margin of 26%. And the return on equity is absolutely massive. It's almost 200%. Free cash flow almost $9 billion right now. Total revenue is total return in the last 10 years. We're looking about 13-16%, 13-14%. And next year we're looking about 5% growth, and then 7% every year after the next 5 years. Fairly valued right now, $255 per share is where it is at. This company is actually going through a transition right now. They're buying a new, basically adding a new company to their portfolio. So I will be looking at that again, and I'm going to look at the debt levels and how much actually debt they have right now, and how much of that money will basically come out of the free cash flow, and where the rest of that money is going to come from. If it turns out to be the fact that it's the debt level is going to increase, then I'm definitely going to sell, because they already have a very high level of debt. So that is just me being transparent with you guys. So if you're thinking about this company, do your research before you look into buying, into adding to your portfolio. I do own it. Okay, just to be transparent, I do own it. I still have it in my portfolio. I'm up about almost to 34%. So right now as we speak, but because of that debt level, because of they buying new company, I think for over $20 billion dollars right now. So you just need to be careful. Next one is Eli Lilly. This is $349 billion market cap company. Is a pharmaceutical company. Is very one of the largest out there. It has wide economic moat, $359 per share. Dividend is very small, 1%. 5-year growth rate, latest dividend was actually 15%. Can you imagine 15%? When was the last time you got 15% from your work? Right? So if you invested in this company, you'll be getting 15% increase on your dividends, okay? And then in terms of the 5-year growth rate, we're looking about 11%, payout ratio 45%, which is very, very low, and dividend streak basically 7%. 7 years, basically increasing that dividend. Safety 96%, so absolutely beautiful. 20% in profit margin, 65% return on equity, free cash flow of $5.3 billion, total return 23%. Next year, they're expecting about almost 10% growth, and then 18% every single year after that. Premium right now, I would not touch this right now as we speak. I'll be honest with you, you'll probably be better off with Merck, which is very similar right now than actually this company, because it is expensive. I think Merck might be a fair valued at the moment, but this one seems a little bit too expensive if you like. But again, great company, quality business, and increase their dividend 15%, which is absolutely amazing. The next company, the fourth company we're looking is Abbott Laboratories. Again, another pharma company. It has $194 billion market cap, narrow economic moat, price right now $109 per share. Dividend is 1.7%. Latest dividend increase was 9%, which is absolutely amazing. 5-year growth rate of 12%. Payout ratio only 33%. Safe in terms of the dividend streaks, 50 years of paying that dividend. They are dividend kings, definitely. Safety 71%, 17.5 profit margin, 22% return on equity, and $8.5 billion of free cash flow. And return in the last 10 years, we're looking at about 9%. Now, next year, they're expecting the earnings to decline, because maybe one of the things that happens with these companies is if they have their pipelines of obviously product actually changes every single year. So if one of the patent for one of their products is actually stops next year, and they might lose a lot of that revenue and so on, and then the following couple of years they pick up again because they do have new drugs and all of that stuff, right? Morningstar, we look at it fairly valued at the moment, $104 per share. So right now it looks like basically it is fairly valued at the moment. Next one is a company I own in my portfolio. I've been talking about this company forever in the last few weeks. Is Broadcom here. It basically has a $233 billion market cap. It has narrow economic moat, $560 per share right now. Dividend yields absolutely amazing for a dividend growth company that's in the tech company. Tech companies do not pay a lot of dividend, but this one actually does. 2.85. Its latest increase was 12%. Absolutely amazing. 29% in terms of, by the way, if you want to look at the I've done a video recently, I think it was last week or this week, or I can't remember, just very recently. Okay, I've done a whole day, basically looked at basically this company from left to right. So just if you want to know a bit more about it, a bit more deep analysis, just go and watch that video. Okay, so 12%, 5-year growth rate 29%, payout ratio 44%. 12%, 12 years of increase in that dividend, 67% of safety, profit margin 27%, 38% return on equity, $15.3 billion of free cash flow. Some of this money, they might use it to buy VMware, so that's another thing that's still in the pipeline for this company. Total return in the last 10 years, we're looking at about 35%, which is absolutely huge. I don't think they can repeat that, but inshallah, if they can, that would be absolutely amazing. Next year, only 6.6% growth, and then every year after that should be about 8%. Right now, it's actually discounted about 8%. $624 per share is where it should be. Right now, it's $560 per share. All right, we're almost there. We've got 2 more companies, and then I'm going to show you from Sharia compliant side of things. Next one is a Striker. This is pharmaceutical company again. Is one of the companies that actually provide a the equipment that's used in hospitals and so on, rather than actually developing the drugs themselves. Okay, $96 billion market cap. It has a wide economic mode. By the way, they are competitors when it comes to Medtronic, so these two are very much the only two. There's a couple of others, but the only main ones that develop the equipment that are used in hospitals and so on. $247 per share right now, and then we're looking at dividend yield of 1.18. Latest increase was 7.9, almost 8%, which is absolutely amazing. 5-year growth rate 11%, payout ratio 31, 30 years of increasing that dividend, 90% safety, profit margin almost 14%, almost 16% return on equity, $2 billion of free cash flow, and 17% total return in the last 10 years. Next year, they're expecting almost 8% growth in terms of earnings, and then 7% every year after that. 27% premium right now. $200 basically is where the price should be. Right now is $247. So we'll see where that goes. The final company is one of the all-time favorites. I like this company because I own Visa. I actually said, you know what, absolutely enough is enough. So I sold it not long ago. I think I made profit of about 400, 300. I can't remember whatever it was. But MasterCard is one of the amazing companies out there. $344 billion market cap. It has wide economic mode. 344 as well. $344 per share right now as we speak. Dividend yield of 0.64, very low, but again the payout ratio is very low as well. But 16% growth. They actually increased that dividend just this month, 16%. 5-year growth rate of just 18%. Payout ratio very low, 19%. 10 years of increasing that dividend, 99% safety, 45% profit margin, 145% total return on equity, $10 billion of free cash flow, total return 23% almost. Next year they're expecting about 15% growth in terms of earnings, and then next 5 years about 21%. Fairly value right now, $369 per share. That's where it should be. So that's why it's fairly valued. So if the fair value is 369 and right now it's trading 344, is probably good entry for anyone that is still looking for that tech company that has a very sticky kind of business. I'm sure if you look at your wallets right now, you'll find a credit card that has basically MasterCard sign on it. And then guess who designs that and who has the technology behind it? Either MasterCard or Visa. That's why I love those two companies. Now, in terms of Sharia compliance side of it, so I'm going to quickly show you. Let me actually zoom in. Maybe you might not be able to see it, but there you are. Every single one of these companies is actually Sharia compliant. The only one that, like I said to you guys, I'm a bit worried about is this one here. Even if you look at Zoya right now, it will tell you it's actually not Sharia. Basically, it's not Sharia compliant. But Zoya has the basically old, they haven't updated their market cap. So if you look at the current market cap of this business, and if you divide the current debt by the current market cap times by 100, you will get this number right now. Obviously that fluctuates. At the end of the day, they might go up, it might go down. But my concern, like I said, is if they are using some of the cash they have currently or financing through debt to buy the new company, the debt level will increase, which means this company will become Sharia compliant very, very soon. So you have to be very, very careful. But the rest of them seem okay. Okay, the rest of them seem okay overall. I hope you like the video. I hope you're enjoying the content I'm putting up here. If you do, please like the videos. Okay, Amgen, like I said, I own in my portfolio. I own Broadcom in my portfolio. The other companies that I own that is on this thing is, in fact, there's none. Yeah, that's the only two I think that I own in my portfolio that was on this list. The rest of them, I do not own them. But would love to own this one, inshallah, at one point. I don't know, if MasterCard goes down quite a bit, I might actually buy it back and then trade it, inshallah, later on. But yeah, that's the video. I hope you're enjoying this kind of content. Have a wonderful day. Assalamu Alaikum.